Hello, everybody, and welcome to Parrot Analytics Live. To get started, I would like to extend a special welcome to our Demand 360 enterprise customers. We are looking forward to talking a little bit more with you all about this material that will be presented today. My name is Samuel, and I'm the VP of Marketing here at Parrot Analytics. Our topic for the next little while is content valuation, how to better recognize the dollar value of your project in a global marketplace. I now have the pleasure to introduce you to our hosts, our VP of Applied Analytics, Alejandro Rojas, and our Director of Strategy, Julia Alexander. Perhaps you've seen Julia on stage at MIPCOM talking with Karen Manderbach when we launched content valuation at on the big stage last year, or maybe you were in the room at the board and member meeting in New York at the International Academy of Television Arts and Sciences, where Julia and Ale were on stage, where they unpacked content valuation a bit more there. In any case, it's fantastic to have this dynamic duo with us here today, and I can't wait to get into the webinar. Just a couple of things before we get started, a couple of logistical admin things. We've received all your questions. Thank you. There's been quite a few of those. So we'll pick out a couple and answer those at the end of the webinar. And I'll moderate the chat today. So if you've got any questions throughout the webinar, please put those in the chat. And then we'll get to those as well as we can at the conclusion of today's webinar. All right, I'd now like to hand over to Alejandro and Julia.
Thanks, Samuel. I appreciate it. Ale, why don't you kick us off, and I will control the PowerPoint on our end.
Yeah, so like the topic today, and I think the reason that we're here is to kind of discuss, do like a deep dive on a content valuation on a specific show. We're doing Succession today. And the dynamic that we want to kind of follow is a little bit of like letting you guys know, like, how do we approach the problem of content valuation, and also what are the implications, right? So the reason that both of us are here is more or less to kind of bring a discussion into the room, so that everybody kind of, trying to answer all the questions related to content valuation. So I'm excited to kind of kick it off. And with that, Julia, like, maybe let's just start talking about, like, the show in terms of demand, which is the atomic unit that we all know and Parrot is known for. And then from there, we can jump into like how we approach valuation.
Would love to. And one image that I want everyone to keep in mind as we go through this, Ale and I are here to present the how and the why of content valuation, how we do it, how you can use it, and why in certain situations or in any situation, it's really an indisposable tool that you should use within your company. And the image that I want you to think about is Lego blocks. The how is the blocks. It's the different color blocks that you get in our content valuation. The methodology that we're going to walk you through is giving you those literal blocks to build. And the why is what you build with them. The why is how you use those Lego blocks to create something of utter importance and really create a strong return for all the time that you're spending on it. So with that in mind, let's get into the how and why of content valuation. So when Succession first premiered, as we can see from this time shift chart, the purple line looks at the demand for the first season within the United States. You can see that within the first month, it's really kind of struggling to find its audience. But as more people come to the show, about 5 or 6 weeks into into the first season, you really start to see the demand grow towards 15 times the average demand of all series in the United States. This puts it in the outstanding category, which for non-clients of ours, that represents about 2.7% of all series within the United States within this time period. Succession, as it is now in its 3rd season. And when we look at the orange line, comparing that to the purple line, we can see that it has jumped up quite spectacularly. We can see these peaks and valleys, and each peak is a new episode, and we can see that audience really staying with it throughout. And we're seeing it sit between 30 and 45 times the average demand of all series in the United States. This puts it into the extraordinary category, and that's about 0.2% of all shows within the United States. And so we can really see how between the first season and the 3rd season, it really found its groove. And so if we look at the first season, the second season, the third season, Succession is really this idealistic picture of a show working as well as a show, as one that can imagine a show should perform. Between the first season and the third season, it has more than doubled, almost more than tripled its overall demand in the United States. And we can see that audiences are sticking with it and tuning into each episode with kind of a fervor that you hope to find in a weekly release series. I'll pass it over to Ale for this slide.
Yeah, so I mean, I think the great thing about demand is like it allows you to compare like multiple shows at the same time, right? Like we really track thousands of shows in hundreds of countries, and we have like a unit measurement that gives you a standard measurement of demand. But a more interesting question is like, okay, once you know that, really, what is the value that is being created? And for that, we need to go back to like, really like what is the contribution that a specific title brings to every platform or every catalog. So if you think as HBO and HBO Max catalog as a whole, where like you have a bunch of shows, every show is adding a little bit of demand to the equation. And we isolate what is the demand share that Succession is bringing to the table, we see is 2.2%. So that starts giving you a sense of like, okay, that's interesting. Like, we now get a sense of like, what is the relative importance or relevance that Succession has in the overall picture, right? Like when we look at the whole catalog of HBO and HBO Max.
One of the strong suits too of demand as a metric, as a foundational metric for our content valuation measurement system, is the fact that you can apply it to any platform. That's kind of one of the key magic, one of the key parts of the magic that we can do here. And so if we look at Succession being, 2.2% of all demand across the HBO catalog, one question that you all might have is how would that demand share change if you looked at Succession on Netflix or on Hulu? And part of what we can do with demand, because we can look at different platforms, is try to determine what the actual demand share on a different platform might look like. It might be more, it might be less. And I want you to keep that in mind as we go through this, because content valuation is also not just dependent on one platform. We can look across many different platforms based on how we compile our demand expression.
Yeah, and just to kind of run off that point, because there's a question related to advertising and how that, like, how do we measure that? So when we're talking about demand, it's all about like, it's a signal of intent. So it's all coming from consumers showing express interest to either consume the show or like talk about it. So there's like a multiple sources at the end. When you combine all of those signals, essentially you have a very interesting, I mean, it's like the way I would describe it is like the atomic unit of the industry, because in a way, once you know how much in demand is a title, then that's going to tell you a lot about like how that platform is going to do. And that's actually what we show in here, because when you look at this chart, what we did is like, we went back, years, and we looked at the demand of the Netflix catalog across different geographies. And we correlated the demand to the number of subscribers that they attract. So if we look at each of these charts that you have in here, essentially on the horizontal axis, you have a measurement of demand of the catalog. So think of that as like adding the demand of every single title that you have in catalog. That's going to give you a total number of units. And you can basically track that over time. And what we see, again, across all these different geographies where Netflix is present, is like a strong correlation between the two, which really what it means is that if you add a little bit of demand, then you know that that's going to add a little bit more subscribers. So that direct relationship really means like at the end of the day, demand determines what is the revenue contribution that a specific title is bringing to the table, independently of like, how much money has been spent on marketing. We're not trying to answer that question yet. Let's just focus on the revenue side. So the demand unit is the best indicator that is out there in the market to essentially link consumer intent to like financial performance. So think of those two axes, right? Like the horizontal axis is more consumer intent, consumer signals, And the vertical axis is all about like, financial performance that is being driven by the number of subscribers that you have.
And because we can look at consumer intent as well as consumer behavior, we can look at those patterns. We can also help answer many different questions. So if the prominent question within an organization is we are looking specifically at acquisition and retention, how does consumer behavior and consumer affinity across a product or across multiple products, as we're going to get into in a little bit, really dictate how well that's going to help us strategize our portfolio optimization, our content optimization around retention and acquisition issues. That being said, just to jump off what Ollie was saying about advertising, if your main concern as an advertiser or as a company that's looking to work more strongly with advertisers and demand more within negotiations with advertisers, understanding how consumer patterns and consumer behavior affects engagement for a prolonged period of times across different platforms, and what titles really lend to those types of strong engagement across one single platform, that's really going to help you talk to advertisers and better understand for them how they can get the most out of the investment they're putting in, and what titles and what strategy is best used when working with those advertisers as well. So there's different aspects of the consumer journey that content valuation can help answer.
Yeah, and also like going back to that consumer journey, because there's a question related to like consumer intent. Essentially, it's all about activities that at the end of the day, when you combine them all, really it tells you that a show is either on demand or not. And the best empirical evidence that this works is the fact that we see that high correlation between, demand and subscribers, right? And that's really the link to then like assess and say, okay, if you know what is the demand of a title, then essentially, the demand of a title relative to the rest of the catalog, then you know how much revenue that title is bringing. And that's really what we're doing in here. If you think about like the different elements that we're showing in this slide, the top row, we start with the very top line of HBO and HBO Max revenue. This includes like, by the way, basically revenue that comes from like cable subscriptions, right? Like it's not limited to HBO Max as the retail side. It's basically all revenue. So that's the top line. Then from our data, we're able to assess out of all of those revenue, what is the revenue that is really being driven by the TV catalog as opposed to the movie catalog. So that's the first step that we take. Okay, let's just understand, given that we have this granularity of demand by movies and by TV shows, we're able to assess and say, okay, we now understand like what is the revenue that really TV shows are driving. So that's the second row that you see in there in purple. And once you have that, then it's all about like trying to unpack the relevance and the impact that a show like Succession is having. And essentially it's like looking at what is the share of demand that show has relative to the rest of the catalog. And once you have that, essentially it's a simple multiplication. You have the total revenue generated by TV content times the share of demand of the title, and then that's going to give you an amount that basically is the revenue contribution that title is really providing every year in this case. So if you add the revenue contribution of every single title that you have on the catalog, you're going to reach to the total amount of revenues that any platform is generating. And that's why it actually works across any platform. At the end, it's all about like really isolating the platform, isolating like the catalog that platform has, and then like essentially adding what is like the additional revenue that each title that you have in catalog is adding. Yeah, so, and we can do this, like that example, the previous slide was showing like, it's like a snapshot over the last, since Succession started back in 2018. But we actually do this the way of doing this is like we do this market by market. So like, think of this as like understanding, okay, if you go into HBO, let's just look at the US as a market. Let's see how much revenue US is making. And then let's see how important is Succession relative to the rest of the catalog in the US. And then you repeat that in all the geographies where like HBO and HBO Max is present. By doing that, essentially you're tracking this on a daily basis. And in this view, we're showing you how much revenue you're accumulating week by week. And the colors of the chart essentially tell you like, where's the revenue coming from? If we think about 4 regions where like you have US and Canada in one, then you have Asia Pacific in another, and then you have LATAM, and then you have Europe and Middle East in another. Essentially, you have different colors. In the case of HBO and HBO Max, most of the revenue, is coming from the US, because it's still like mostly like a domestic. That's where like the core, like most of the revenue is being generated in that market. So that reflects a little bit that, but essentially think of this as a tool that can give you that perspective, like you're seeing how much revenue every title is bringing to the table every day in every geography, so that's kind of like the way to think about this. And of course, like you start seeing like, what are the picks of the season, right? Like clearly you see, oh, okay, what happened in season 1, then what happened in season 2, what happened in season 3. Obviously it's a growing show, but you definitely see like where the peaks are happening across like the whole, timeline.
And I think what's key to this chart and then the figure at the top is because we can look at it by different geographics. You can go as small as you want, you can go as macro as you want. This answers a bunch of different questions. If you're looking to acquire a show for a specific region and you want to understand the value that that show is going to contribute or has contributed to a current platform, you're trying to better understand the financial side of that show. Think about the fact that Succession over 3 seasons has contributed more than about just under $450 million as of Q4 to HBO and HBO Max globally. You think about the fact that HBO or Warner Brothers Discovery spent $425 million for Friends over 5 seasons in the United States. You kind of get an understanding of how you can approach shows from both an acquisition and a licensing standpoint. By looking at what a show's historical contribution has been to a platform or to a network, and what that might look like contribution-wise to your platform, dependent on audience, dependent on the affinity between or the overlap in audience interest between that show and another show, its ability to retain or acquire new customers, its ability to increase engagement across a consumer base. You really get to understand how that daily value in specific regions or from a global level can look like, again, if you're both a buyer or a seller.
Yeah, and I think that's important to mention, like, and let's just not go into season economics yet, but like the whole fact about like the key drivers of the business, right? It's like either you attract or retain subscribers. So the unit measurement of demand, as we measure it, which basically has like all of these signals of intent that we're talking about, essentially really tell you that interest, so that either it allows you to keep subscribers in the platform or attract new subscribers. And the fact that we can do this on a title by title basis, then it allows you to break it down so that we know when we're talking about the share of demand, we're actually talking about like what is like, like the ability of a title to retain a specific number of subscribers or attract a new set of subscribers, right? Like, and that's where the business is really being generated, right? Because like if you have a subscriber, then the subscriber either is going to pay a monthly fee, right? And that subscriber may be new, or that subscriber may be one that you already had, but you were able to retain thanks to that title. So again, like when we're talking about how the revenue contribution is calculated, it's all about like understanding how every title adds to that total amount of subscribers that you have, because those are the subscribers that are paying every month. And that's how you generate revenue, really.
Mm-hmm. And because the content valuation measurement system is based on, again, the demand expression as well as consumer behavior patterns that we build into a lot of our data, if you think about, again, that kind of those Lego pieces, you really get an idea of what you can start to build up to. What are the most important pieces that are going to return the strongest level of, they're going to return the highest level that you need for your investment. And then when you have spare pieces, what actually might be more beneficial to license or sell elsewhere, because it's not going to necessarily retain or acquire, or if you're looking at a advertisement supported system, it's not necessarily going to engage at a higher level compared to other titles that you have. And so these are all built into content valuation reports that we provide, but they're all aspects of answering 2 questions, right? How much is this worth? How much value is this providing? And within that, why is it providing this amount of value? Is it because of acquisition retention? Is it because it's what the platform specifically needs? Is it filling a hole? Is it leaning into what audiences are expecting out of it? Is it helping with brand affinity? All those questions, the hows and whys, are part of the content valuation system.
Yeah, and actually, I love that analogy about like, you know, thinking of this as Lego blocks, because that's really the way to think about it, right? Like every title is going to add to that like castle that you're trying to build, right? And then how relevant is that Lego piece is really becomes part of what we are basically giving you the visibility into. And the way we do that, it's a good segue into like how we think about like season economics, right? Like every show, especially, I mean, TV obviously like behaves in certain ways. And like one of the things that we've been able to do is actually like unpack how every season generates revenue. So if you think from that perspective, in the case of Succession, as we said, like there's been 3 seasons, you can think about like, think of mentally as like looking at 3 quarters. So like think of like the first quarter when like the you know like the TV show was released. So like the first 13 weeks since you put on the show, what happens? And then what happens the next 13 weeks? Okay. And that would be what we call the post-season period. And then what happens in the next 13 weeks, which would be more like off-season, you know? So if you think from that perspective, we can break down how much value is being generated across like all of these different periods. And what you get is essentially like a very interesting picture, because it tells you, okay, how much do you, like, as you would expect, right? Like there's a peak on revenue in terms of like once you release the show, then like there's a kind of like a larger drop in interest because like, you know, like the season was released. And then there's more like, you know, the off-season quarter where it drops, but it's more of like a library title, let's say, you know, so that's kind of how it behaves. But looking at this from a season by season perspective, it allows you to then, if we go into the next slide, Julia, it allows you to start thinking, okay, how can you use this to start projecting future scenarios, right? So when you think about that, in this case, we start with a basic question, which is like, okay, how much revenue are you generating in those first 13 weeks, okay? If you do that, you see like big increase from season 1 to season 2, 45% increase. And then from season 2 to season 3 is a 30% increase. So now you have basically a metric that allows you to start thinking about, okay, what's going to happen once we release season 4 and season 5, right? You already know how the show has been behaving over in the past. And then you can use this past behavior as a way to estimate how well it's going to do in the future. For this exercise, we assumed like that season 4 and season 5 were going to grow, but at a smaller rate than it has done like for the first 2 seasons. So we assume it's 20%, which is kind of similar if you look at how it's been evolving. It evolved from 45 to 30. So we think, okay, the next one may be 20, and that's how it's going to evolve. So very clearly, we tell you if we're going to project this going forward, because I mean, it's interesting to look at how much revenue has generated in the past, but also more interesting is actually to see how much revenue you're going to generate in the future, so that you can see what is the value of the property as a whole, right? So in this case, we can start thinking about like, okay, we're going to project this going forward, and we're estimating like the season growth to be 20%. So that's one element. Then, and I don't know if you want to add something to that, Julia.
Yeah, just really quickly. What I think is really great about the ability to look at growth, and then we'll get into the other side of that, which is also crucial to this equation, is the fact that because content valuation as a system is so malleable and so adjustable, you can look at, it doesn't have to be just 13 weeks. You can look, if you're looking at 4 weeks, if you're having a binge release, you're like, I want to look at 4 weeks, and then I'm not releasing another season for a year, and I want to see what the growth may be for a show with that type of release model or that type of release structure. Is that actually more beneficial for my overall return, or actually should I space it out over 8 weeks? And how does that affect the growth rate for future seasons? How does that affect how audiences are engaging with it? And how does that affect the next segment which we're about to get into? And I just want you to keep that in mind as we move away from just weekly releases or just binge, as we really start experimenting with different types of structure, we can look at how that structure actually impacts the overall value and overall revenue contribution from a show between the first to 5th to 7th season. But I want to jump forward to the next slide because we have a complementary data point to this.
Yeah, so I mean, I think that's a great point to kind of think about like how we can kind of change these periods and how like the release strategy is going to impact all of these. So every show basically is going to behave differently depending on how you release it, right? Like, but in this is like the typical release. So like it basically behaves very like it follows like a specific pattern. And what you would expect is like, okay, you have the season over season growth, but another metric that is relevant is how much does it drop in like demand? You know, what is the post-season decline? So essentially, if you look at, you know, like let's just take season 1, for example, we see that like after the first 13 weeks, if you look at the next 13 weeks, like the whole revenue drops by 37%. If you look at season 2 is 18, and then if you look at season 3 is 31%. So more or less, you know, obviously every season might be a little bit different in terms of how it behaves, but like it starts telling you, giving you a picture of how like this show behaves in terms of like, you know, the overall like consumer behavior. And when you're trying to project this, again, like we're using this historic data to start thinking about how we're going to project this for season 4 and season 5. Then like one of the assumptions that we have is like, hey, we can just take the average of all of these and it's like 29%. So that's what we're going to use for whenever we launch a new release, a new season, then like the post-season period, we know it's going to drop by 29%. That's what we're going to use to kind of project going forward.
And what I love about understanding the growth and decay metrics as much as we can is if anyone has been in a room with me before, that you've heard me say this, one thing that we are it's super important to us here at Parrot is ensuring that we really reiterate that data is a lighthouse, right? Data is going to shine a light on really fortuitous paths and shine a light on really dangerous paths. That might be oversaturation, that might be white space of opportunity. But our goal is never to say, you know, this is a show that should be canceled or whatever it might be. What we're showcasing with something like decay metrics and growth metrics is being able to go to teams and say, hey, here's what the runway on a show like this might be when you're talking to the creative teams that you're working with. If you are on the development side, if you are on the acquisition side, if you are looking at the distribution side of things, that question about when do we know when our audience is going to fall off at the exact point that it no longer makes sense for the investment that we're putting in, how does the decay rate, the projected decay rate for 2, 3, 4 seasons really impacts how we want to have a discussion with our creatives if we want to have that discussion with our creatives. It is that lighthouse to again showcase that when you're thinking about it from a revenue side of the equation, and television and film it's a creative arc, as you think about the revenue side of that art equation, how much juice does our audience still have in this? And then potentially, how can we take that juice and find ways to really lean into them and give them a new experience, whether it's a spin-off, whether it's an addition to that world. That's something that the creative teams can discover, but this is really to showcase that we can project and we can show you how that growth and decay rate are going to come to a point where it is impacting the top and bottom line.
Yeah, and that's such a great point, because also the other thing that we can do is like we are only showing you Succession as an example, but in truth, we can calculate this for any show, right? So at the end, you can kind of put this drop and like this decline in perspective. So you can see like, okay, 31%, how does that compare to like the decline that other shows experience are similar? So that's a great thing about this, right? Like, so like, a decline doesn't necessarily mean that it's bad. It's just a regular behavior of TV. And the fact that we can do this for every single show, it kind of puts like that decline in perspective.
Yeah, and we can see with certain genres, certain patterns emerging. Ale and I have been at work on content valuation for quite some time, and something that may not seem really surprising, but is great to see in the data, is that really premium drama series like Succession, something like The Crown to an extent, or Bridgerton, those are going to see higher levels of decay rate. And if you just think about consumer behavior, that makes sense, right? Most people are not rewatching The Handmaid's Tale over and over again once they're done with the season. It's a really heavy show, but they really love it. It's an artful piece that they want to watch. Sitcoms like Seinfeld or The Office tend to have lower decay rates. And if you think about it again, those are shows that people come back to, right? South Park, The Simpsons, those are shows that people have on in the background. Those are shows that people watch when they go to bed. It's what they watch when they have a bad day. And so understanding how decay rates affect certain genres, and then within that, certain subgenres, can also help with portfolio optimization when you're thinking about building out that slate.
Yeah, totally. Yeah, and that leads into the next slide, which is like understanding that decay more from a perspective of almost like as a library title, right? Like you think about like, you know, how this analysis is done, that orange section, it just happens like 6 months after the release of the first, you know, of the season, right? So it's almost like in the off-season period, how much did it decline relative to the quarter before? And that will tell you more or less how the natural decay rate is going to be down the road, right? Like more as a library title, if you want to think about it from that perspective. So in this exercise, one of the things that we see in here, you know, like season 3, actually, like that decay rate is 15%, which is a little bit higher than season 2, but season 2 was super low, it's 8% only. So this is a show that is still, you know, during off season, is still drawing a lot of demand that maybe for season 1 or season 2, doesn't, from the way we calculate this, essentially is demand for the show, right? So it may be that, you know, like after season 3, people are like really connecting to season 1 and watching it like in delay. That's part of the behavior of the consumer. That's totally fine. What this captures is like, how is that behavior evolving over time? So you're able to project going forward, you know, how that decay is going to look like, especially once you don't have any more seasons, you know, because you also want to think about a period where like this title is a library title, right? And it's already done. And then what happens there? Is it like a slow decay? Is it like a rapid decay? That all has impact in how much value it can generate, because we're looking at the value in the future.
Right. And what I love about that is that we see off to the side, you know, the off-season decay rate that Ale and his team had forecasted for season 4 to season 5 is actually lower than season 3. And so what that really demonstrates, into Ale's point, we can then take into account, if you wanted to project out, if you added no more seasons, how would that decay rate change with each year, depending on how the demand behavior it looks, and depending on how people are interacting with the portfolio as a whole. It really is going to help you in terms of understanding how you can potentially, everything from curation teams who are looking to put things on the homepage, to what to recommend, to marketing, if you're looking at finding new ways to bring people into that show or whatever it might be. What's the level of investment that you can put into that show versus if you don't put any investment into it, what is the return that it's still going to generate? So all of those what ifs and what then questions that you have, we can model out with the projections.
Or even like how long to wait between seasons, right? Because like if you have a show that essentially has like very low decay rate, and like maybe like the decline is not that high from like, you know, releasing new seasons, maybe you're like, hey, maybe I can just wait a little bit longer because it hasn't really been decaying that much. It's still generating revenue for me, and I don't have to spend like the extra money in creating like the new season production and all of that. So a lot of things that you can do with this. I mean, essentially, it's all about like giving you the tools to start like making these decisions in a way that is easy and understandable. So with that, I think it gets us into really what we were going after, because like we knew like all the historic performance, but we want to know is also like what happens going forward, right? So that we're able to assess what is the value of the property as a whole, right? And that's kind of what we show in here. Again, like all of these projections are really built on those like, you know, metrics that we shared before. But it makes it very easy, right? Because like once you understand that, essentially, you know, like the only assumptions that you have to make is like, okay, like when is it going to be released the next season? and then season 5, when is it going to be released? And once you have that put into place, like you have a set, understanding of like how much money this title is going to bring. And in the case of Succession, we look at the total value is more than $1 billion. It turns out to be more than $200 million per season.
And I think what we should really stress here is that when we look at that $1 billion projection, that includes season 5, but doesn't include a new season beyond that. So that show is a $1 billion show based on 5 seasons of a series with a rather low decay rate. A decay rate that seems like, season 4 and season 5 is actually, again, lower than season 3. And so this is the type of show that is going to continue to generate meaningful revenue despite no more investment beyond a certain year. And of course, as years go by, the decay rate increases slightly, and that decreases the revenue contribution. But when you take into account the lack of investment being put in from a production side, from a marketing side, the fact that eventually it is totally owned and it's on that platform, you get to a point where ideally that series is just continuously generating a meaningful amount of revenue because of the affinity to the platform and what people are seeking out in the low decay rate. And that's something that, again, we can project out to a certain extent and really helped, again, to shine a light on what happens if you don't continue with the season in terms of a revenue perspective. What happens if you do continue it? What is the ideal investment to put in order to generate the strongest return? All of these questions are answerable with content valuation.
Yeah, and one of the things which is related to some of the questions that I'm seeing here, we're getting a lot of questions, but like, like also looking at like what is the growth of the previous seasons can tell you a lot about like, okay, what to expect next. So, like most of the shows, actually the shows that we have valued, like for them, I mean, if it's like regular show, usually like season 1 does better than season 2, and it's actually like a slow decline. So like when you look at the season over season growth, may be negative. And that tells you that, okay, if you're going to do like an extra season, maybe it's not going to do that well because like people are losing interest. So that's the reason that maybe it's time to cancel out, right? Because it's like, it's not really generating the revenue that you're expecting. And we're going to get into that because at the end, it's like, so far we have only touched on the revenue question, and I think that's fine, but we're going to get into like, what are the dynamics into like making these decisions to actually continue doing another season or maybe actually canceling the show.
And I think there is a preconceived notion that all of the content valuation reports are seeking out positive answers, in the sense of this is a great report actually for HBO, right? This really goes to show the value of Succession. But to Ollie's point, sometimes you see that negative season over season growth and you're trying to make a decision about whether or not to continue a series, or you're trying to make a decision about whether or not the series at some point is actually more valuable to another player, and you think you can actually generate more revenue licensing it out because it's just not doing what it needs to do from a consumer behavior standpoint for your platform or for your own service. Those questions that there might not be insight into because the walled gardens are so closed off. So we actually don't know if you're working at HBO how Succession would necessarily do on Netflix. We can look into that and we can model it accurately based on our content valuation system. And so a lot of the times the questions are, we know, purely content optimization. It's purely what is the best method of release for this title? Is it to be exclusively owned and on an owned and operated platform? Is it to be licensed out exclusively versus non-exclusively? What does that look like? All of those questions, right? You're not necessarily trying to find, or you're not necessarily coming in with, I have the answer in mind. It's I want to know what the best way to do this is, understanding how the current ecosystem of streaming services, of all these different distribution avenues, opens itself up to me and the possibilities for my organization. So all of those are part of the content valuations. Oh, let me just.
Totally. Yeah, so that once we get that projection, the other thing that I think is interesting is more about like understanding what is the competitive and the strategic value that a title brings. One of the things that we can do is essentially look at like consumer behavior in terms of like consumption of titles that may not be on the same platform, because like we have we own like a set of like a portfolio of patents on a technology that allows us to see like people who are downloading content on like open streaming networks, We're talking, this is like about 400 million people that actually do this on a regular basis. And once you do that, essentially you have evidence of a user who may watch a show that may be on Hulu, like maybe they watch The Dropout on Hulu, but then after that, they watch Succession. And with that, you have it's like millions of trips like that, or nodes where you have that connection. And this is such an interesting data set that, because like with that, you can essentially establish if a title is good for a platform in terms of acquiring new subscribers or retaining new subscribers. If we look into like Succession, like maybe let's just let's do like a deep dive into how it looks. You can kind of see how that, again, it's like all of these like lines that you see there is a specific title, and essentially you're tracking people who watch a title and then watch Succession, and then like on the right hand side, you actually watch you're tracking people who watch Succession and then watch another title, right? And if you aggregate this by the network where this title is available, essentially you have a view into the market and what is like, how does this title fit in that overall picture of the market?
Yeah, this is my favorite slide, I think, in the entire presentation, because I spend my days thinking about portfolio optimization and content optimization. And so when you look at this specifically, right, again, if we think about back in the day when there was like, a few channels, you could basically see where the vast majority of the attention share was, where the audience share was actually their time was spent. They're watching Law and Order on Tuesdays or whatever it might be. You could see that. As we get more closed off walled gardens, as we have a lack of transparency within a lot of the data that we get, it's really difficult to understand. And as platforms get more fragmented and audience fragment, it's really difficult to understand where they're spending their time and their attention. And also within that, what is attracting their attention? How can you then better monetize a lot of that attention, a lot of the love that they have for all these different products? So I just want to give an example of how you can look at a lot of this data. Hypothetically, if you're Netflix, you are seeing that 32% of people who watched a title on Netflix then watched Succession. That's not information that the Netflix team is going to have. What's more interesting is that people who watch Succession, only 9% of them then went and watched a title on Netflix. So for a company like Netflix, a title like Succession is a really strong retention title, but it's not a great acquisition title. And within that, you can then go within the people that it's retaining, and you can say how many of the customers that Succession retained for Netflix are high churn risk subscribers. Therefore, what is the actual value in this title? If it's retaining customers who are low risk, that might not necessarily be worth what you're going to spend on that title. But if it's going to retain a large portion, a significant portion of high risk churn subscribers, then what that does for you in a really competitive landscape, let's say the United States and Canadian market, where all these companies are both trying to scale, but also retain those customers and increase the lifetime value of that customer. Understanding, again, those Lego blocks, how certain shows and films interact based on the consumer journey, based on what they're actively seeking out, and trying to build as close to that as possible, you really get a fundamental understanding of the type of castle that you're trying to build. Instead of just saying, well, we have the internal data on what our customers are watching on Paramount Plus, or we at Netflix know what our customers are watching on Netflix. What they don't know is where their customers are going elsewhere and what they're watching, beyond that next title. What's the third or fourth title? And then within that, what are some patterns that you can take away to then better optimize your content strategy team? So this data set that we have is extremely valuable to me. I use this data set every single day, and I think it's just really interesting when we think about how many series and films there are and how many platforms there are and how people are spending their time with them.
And then the big advantage of that is the fact that you can use all of this data to analyze what is the role that a specific title is playing within the catalog, right? So if we look at HBO Max catalog, and each of these dots that you see, there is a specific title, you're able to measure, what is the acquisition power that a title may have, and also what is its retention power. And then at the end, what you're gonna get is almost like two quadrants where there's going to be some titles that are basically most of the value being derived from them is because they are attracting new subscribers. And then there may be some other titles that is the opposite, right? Titles like, like Last Week Tonight with John Oliver, or like even Curb Your Enthusiasm. It's more for like retaining, your existing audience. And that's like, it's interesting because then like, we're trying to assess, given like we know what is the value of the title, we also want to know how is that title deriving that value in terms of like either adding new subscribers or retaining subscribers that you already have. Those are the two ways to actually generate revenue, if you think about it.
And because we can look at these series on an acquisition versus retention platform, and because we can actually dive into the consumers who are watching these series, what we can also do is then break that down further into demographics. So if you're a platform like HBO Max, and you're seeing that your really strong retention players actually have a more male dominated audience, and your strong acquisition players are actually really dominated by a female audience, how do you use that to then look at your slate building, right? When you're trying to build out for 2 years and you're trying to say, well, we know that a lot of our new titles are acquiring female subscribers, that a lot of our longer running series are retaining male subscribers. How can you invert that a little bit to try and then reach a new male audience or retain a stronger female audience, and do that across a slate? So again, as people are looking month to month, week to week for what streaming service to go to, as they're potentially churn and return customers, the more that we can dive into the audience behavior and how that relates to the valuation of a title and the valuation it brings to a platform, the more information that you'll be armed with in order to make those really difficult decisions. The goal, as Ale said earlier, I love the way he said it, is to simplify a lot of these decisions that have they've always been complex, and they've become much, much more complex.
Totally. And I think adding that demographics lens into this can also give you another perspective. And again, like all of this can be done depending on what is the question that you're trying to answer. But just to finalize on this point, if we just isolate Succession again, we're able to know that 70% of the value being generated by Succession is through essentially driving new signups, and like driving it's more like coming from acquisitions, right? And 30% is more on the retention side. So now we have the full picture where like we know how valuable like Succession is, but also how is that value being generated, and that leads us into like the next calculation, or like again, like we're trying to simplify the decision making for like networks and for producers. And what we see in here, given that we already projected that Succession was going to generate, in the next 5 years, going to generate an average of $128 million a year, and given that we know that 70% of it is more on the acquisition side and 30% is going to be on the retention side, then we can split those, that 128 into 90 million that is coming from gross new subscription, and 38 million that is going to be more on the reducing, like the monthly churn. And once you use that, essentially you can even like translate that into specific KPIs, right? So like in the case of like gross subscriptions, we can basically convert those 90 million a year into 900,000 subscribers every year. And in the case of retention, we can convert those $38 million a year into a monthly churn reduction impact of 0.04%. So again, like this is going to provide for every title this sort of metrics, so that at the end of the day, this becomes like that Lego block that Julia was describing, right? Like now you have your Lego block, you know how much it's worth, and also you know what happens if you put it in or you remove it, right? Like, oh, you're adding 900,000 subscribers, and if you remove it, those may go away, right? So I think that's what's interesting about this approach. It's like it makes it so that you can start making decisions in a way that is like scalable, because everything's going to be measured in the same way, and in a way that is also like being value driven at the end.
And then you can plug a lot of this into the certain calculations or certain figures that I know a lot of shareholders or a lot of people are interested in, whether it's customer acquisition costs, whether it's lifetime value of a customer, by looking at the ability to project this kind of valuation for content, how that parlays into subscriber acquisition, subscriber retention, how that parlays into behavior, really helps to answer some of those questions as well at the most granular level possible. Because again, to Ollie's point, you can do this across an entire slate. You can do this across an entire portfolio. You could really dive deep into it and try to answer some of those questions with as much data on a title per title basis as possible. I'm aware of the time, so I just want to get to our last slide and give Ollie a chance to go over it as well.
Yeah, so I think the last slide is like basically we talked, like the whole presentation has been about like understanding the top line, right? Like what is the revenue contribution that a title brings? But then at the end, it's also like you have to make the calculation and see, you know, essentially if you want to have some growth, some target gross margin, what does that mean in terms of like what is the content spend that you can allow yourself so that the network essentially makes money, especially now where like like I think Wall Street is driving all these networks to really think about like, okay, if you're gonna invest the money, like what is the return on that investment, right? We do this calculation for Succession, we looked at the whole property as a whole. Like we saw that it was making like more than $200 million per season. If we target our gross margin at 60%, so think of that as like that's a gross profit that this every season is generating for HBO Max, then that means that you have $87 million to spend on the production cost of a season, right? So now you have a way to essentially assess what is the right production budget that will lead you to have like the right amount of like like margin that you need for your business.
Mm-hmm. I know that there's so many questions. Samuel, I don't know if you are back with us, but if you are, is there time to answer a few, or how are we doing on time?
I'm here. I actually made a bit of a promise that, look, if you guys are willing, we can push the time a little bit. But look, absolutely, there is 24 questions, both shared with us before you guys got started. And then we had lots of questions throughout the live. So look, back to you guys actually. Pick a few of those and we can just see how we go with time. And then once we need to stop, we'll end the session there. Does that work for you?
Great. Yeah, well, I've got them here, Ale. So I think, why don't I just pose a few to you? Let me just bring them up. Yeah, here's a good one. Can we apply this valuation assessment to older titles or IP that have been held in a library, therefore providing support material to potential buyers, highlighting data positives?
Yeah, totally, absolutely. I mean, if you think about titles like, Friends or Seinfeld, titles that already have finished, right? In that case, we already have like a ton of historic information and historic data that can support the value of that title. So it's almost like it reduces a lot of uncertainty because you know how it has behaved in the past. And then like the evaluation exercise becomes even simpler because essentially you only have to think about like what is the decay rate that this show is like really being observed in the past, so that you are able to project going forward how much value is that going to generate for any platform. So essentially, yes, the answer is yes.
Yeah, and we recently did a study. We looked at a bunch of different titles. Again, Ollie and I have been working on this for a long time now. And we looked at Grey's Anatomy and Seinfeld on Netflix specifically. And part of what we were investigating was whether or not they were both really strong retention or acquisition titles. Which one had kind of a lower decay rate, which one was actually more valuable to Netflix if it's a company looking to license. And we know that they are both really valuable shows to Netflix. And what we saw was that they're both really strong retention drivers, but Seinfeld actually had a slightly higher acquisition value as well as being a strong retention driver, versus Grey's Anatomy had a lower acquisition driver when we looked at that equation. So if you're Netflix, again, these are two different shows appealing to different audiences with some overlap, but accomplishing two different goals. But if you wanted to compare, Seinfeld to a Friends, right? If you were really looking to kind of backfill that, you could really look at, okay, what show is actually more valuable to you in the areas that you're really trying to increase. So to Ollie's point, if you're trying to decrease the level of churn you're seeing, what type of title is actually going to help you retain the largest amount of customers, even if it doesn't necessarily acquire? And that might be fine, because they might be looking to acquire within a segment of Netflix that is relatively, saturated or whatever it might be, but they're still at risk of losing those customers. And so if you're really trying to focus in on key metrics and key actionable activities of consumer behavior, but based on the titles you're looking to license or to license out, we can dive really into those micro questions. Let me see.
Totally.
I think we've got a question. Let's see. This is from Sean at Indie Scene. Do we have marketing costs associated per season? Studios networks usually don't put as much funds into advertising until they meet their benchmarks in demand. I know that we work with many marketing teams with a lot of our clients. I'll let Ale speak to this a little bit, but I do know that is a question that we get.
Yeah, so I mean, I think it goes back to understanding what is the cost structure of a show, right? Like if you know how much a show is generating revenue, you can easily do a calculation to assess how much marketing expense would make sense for this type of show, given the impact that it's having, and also given the impact that it's delivering, because it's different if you have a show that is better for acquisition purposes than a show that is more for retention purposes, right? So all of this can be estimated based on the behavior that we see, and based on how every show is really being valued and every show is bringing revenue to the table.
Yeah, again, and because a lot of our content valuation is based on demand, we can dive further into those questions, right? So if you're looking at the investment that you're going to spend across the board, right? You've got some allocated for production, and then you've got the marketing budget allocated. If you're looking at how to best optimize your marketing needs, our demand metrics are global travelability metrics. All of this parlays again into the kind of content valuation. And so we can dive down in and say, based on the investment needed to hit the level of gross that you want to hit, here's how much you have to put into production, here's how much you might want to put into marketing, and here's how to best optimize that region by region in order to really have the biggest impact. I know that we have so many more questions, but I am cognizant of everyone's time on the call, and including Samuel, Ollie's, and myself. Samuel, I think we can take a lot of these questions, correct me if I'm wrong, and answer them maybe directly between Ollie and I in follow-up emails. But I think that might be the best way to handle it.
Absolutely, guys. Look, good way to approach it. There's no way we're going to get through all of these. So, wow, look, I don't know about all of you, but I thought that was a very insightful and informative session. I hope you were well caffeinated. To be clear, the presentation you've seen here today and the valuation numbers we have revealed today was actually a world first. This is, I guess, your reward for taking an hour out of your very busy schedule to be here with us at Parrot Analytics Live. You can reach out to us directly to Ale or Alejandro, or otherwise the easiest way is to just reply to the email that you will get in the next 24 hours with the webinar recording and a link to download today's presentation. Look, a very last question. Can you provide any insight on how your metric of demand is calculated? Sure, Ellie, we can do that. I will send you a direct reply. Look, thank you again for being here with us today. And we will see you at the next Parrot Analytics Live. Thanks all. Have a great day.
Thank you.
Thank you.